let's say, for example, you have a strategy that trades maybe the top 10 equities, right? In your universe, you will have those top 10 equities within your self.securities array. And I'll show you how to add those in a second. Now, once you've got your sort of data, your securities, there's two main parts to that after that. There's your portfolio and your transactions. Your portfolio, as the name suggests, is kind of what positions have you entered? What are you holding, right? That's useful, obviously, because you want to know, what is my current unrealized position? What's my unrealized profit? And then self.transactions is sort of your middleman for actually executing all the orders, right? So you can look up your orders, you can place the orders, and all of that is held in transactions. So in short, your QC algorithm simply is just an encapsulation of your entire algorithm, and I want you guys to view it as a state machine, right? And talking about state machine, time in the lean engine kind of works like a change in time is like a change in state to your QC algorithm, right? And the way it works is by using something called a time frontier. I have a diagram which will make it clear. And essentially the way it works is your algorithm has some kind of state, right? And each time the frontier moves along, you get some new data, right? And that could be at some interval. That could be sort of every minute, that could be every hour, every day. And you can tune that, which again, I'll show you in the next one. And the reason why we have this time frontier is to prevent something called look-ahead bias. Now, look-ahead bias, it doesn't happen in real markets, like in your live algorithms, but it is very much a possible bug and a pretty hard to detect bug in backtesting, because what it essentially means is you're doing your current calculation based on some future data. Now, clearly, you don't have future data, otherwise we'd all be rich. And so that time frontier just means you can only see data before the time frontier. So that's why we use QuantConnect, and that's why we use Lean. It's just a really great way of making sure you don't mess up your algorithms. And speaking of which, each time step in Lean, you'll get access to two main pieces of data. There's a tick and a bar. A tick is simply a single moment in time, right? The start time is equal to the end time. Now, that's great, but it's also pretty noisy and pretty granular. Can you imagine like a piece of data every single time it updates? It'd look pretty noisy, right? It'd be hard to analyze. But a bar is basically an interval of time, and it contains something called an OHLC price array. And that stands for open, high, low, close. So for those who are unfamiliar, when the start of the bar occurs, the price at that point is called the open. Similarly, when the bar is finished, that's the close. And within that interval, the high is either the highest point, and then obviously the low, the lowest point. And we typically use bars because you can adjust the interval to smooth out your data. And it also allows for better granularity, right? Like if you only care about daily data, just use daily bars. If you care about like hourly bars, intraday trading, then use hourly bars. So yeah, and we use bars, and you should know that bars generally work on the close prices, right? Because the price changes between the bar. Your frontier will work on the close of every bar. So what I mean by that is if we look at this diagram here, so your time frontier will sort of start here, and then it will move to the close of this bar, then the close of this bar. Now notice this is a 6-hour bar, but you can also change that to like a daily. And notice how the events occur at the end of each bar. That was what I meant by the close price. And now relating back to the time frontier, each time the time frontier updates, like either 6 hours have passed or a day has passed, you'll get something called a slice object. And all you need to know is that a slice object is simply just like an object holding all of your data, right? It'll give you the time, it'll tell you whether or not there's actually any data, and it'll give you an array of sort of all those bars. And those bars are going to be crucial for when you need data for your algorithm. Yeah. Okay, so I'm going to pause here for a second. Does anyone have sort of any questions or like concerns about, yeah.
Like you mentioned it before, but like in this challenge, is there like, are we supposed to use a certain strategy, like every 6 hour strategy or like a daily strategy, or is that all up to us?
It's completely up to you. So let your imagination run wild. Like, come up with any ideas you want, try it out, back test it, and there's absolutely, like, we recommend equities, but if you know about crypto or you know about forex, then definitely give it a go. And you can of course be very intraday, or it could be daily, completely up to you. Yeah. Any other questions? More sort of, I guess, the algorithm class, how time works. Any questions about that? Because that's pretty critical to understanding how an algorithm, because like coding a time series related algorithm, you have to put your head in like a different frame of mind, and it'll become apparent when I show the algorithm. But yeah, if you guys have any questions, feel free to just interrupt me. That's fine. Okay, so initialize. I'm going to talk through some of the methods now, right? In your class, and the first one you need to know is initialize. So initialize runs once, right at the beginning of the algorithm, and that's used to sort of set up your universe. Now, here are the different parts that you'll be doing in the setup. By the way, don't worry if you can't remember any of this. Like, we'll be sharing the slides so you can refer back to it. 4 things. The first thing is you need to tell the algorithm, you need to tell QuantConnect. So when is the algorithm going to start? When is it going to end? And how much money do I start with? Typically in algo trading, we start with 100,000. If you do any sort of paper setup, you'll always see 100,000. And the start and end date sort of tests, that'll tell you your back test period. So in this case, I'm doing it from the 1st of Jan 2018 all the way to the 1st of Jan 2020. Right. Now, probably the most crucial part is adding the equities to your universe. And what that means is, do you guys remember when I mentioned that in your algorithm you need access to your data? That's exactly what it is, right? You want to make sure that, let's say I'm trading the top 10 equities, then I'm going to just add those equities to show. And crucially over here, you can see the resolution.hour. That will tell you the resolution at which the time frontier should move. So this will give me hourly data on QQQ, right? Also important to note, don't forget this dot symbol. Do not forget this. And the reason I say that is because there's also another way where you can simply add the equity just by giving the ticker name. That is unreliable and not good practice, because there's a bunch of different markets. Let's say you've got QQQ on one market and then on another. Well, the algorithm will be ambiguous as to which data it'll give you. So always use the symbol because it's like a unique identifier, right? And then a brokerage model. Again, not super important for this, but just good to know if you ever decide to convert your algorithms into live algorithms. That's actually the beauty of QuantConnect, right? Like anything that you write here can be immediately switched to a live algorithm. That's why this platform is so good. And any algo-specific variables. So for example, let's say you were trading something and you wanted to know the time at which you last closed a position, right? And for example, like why would you want that? Well, let's say your algorithm only enters a position every 30 days, right? Like as soon as it's exited a position, it has to wait 30 days before starting a new one. That's often called like a cool down period. It just makes sure that you're not over trading and potentially losing a lot of money. Then you would store a variable like last exited time, and then you can use that to compare what, at each time step. Okay, has it been long enough? Has it been long enough? Has it been? Okay, so that was initialized. That runs once, by the way. It's just the basic setup. Now, this is the best bit. Okay, this is where all the fun happens. That's on data. Now, remember how I said the time frontier moves? Every change to your QC algorithm is a step of the time frontier. Well, every step of the time frontier, on data gets called, right? And on data gets called with the slice object, right? And well, it's pretty hard to generalize on data because it's very specific to the algorithm you're writing. But I've just included like 3 examples. Like for example, Here, you guys remember how I talked about the securities array? That's kind of your universe of all of the equities that you have. Well, you can access that through this securities, and then you can toss in your symbol. Remember, like we defined that variable earlier here, the self.QQQ. That's just what we're going to use here. Submit orders. Again, I'll go more into orders, but that is a way to do that. You can specify a market order on the symbol and then a quantity of 10. And then, importantly, your portfolio. So you want to check, hey, have I actually invested, and is the price falling within, in this case, a simple moving average's current value. So what we call like the second argument is kind of what the signal would be in this case, right? A signal is simply just when some parameters change in the algorithm. Any indication of that is when you will enter a position or exit a position, right? Okay. Any questions so far just on that? I explained the initialize method, which runs once, and onData, which runs every time the time frontier updates, right? And then that granularity can be specified, as I showed earlier. Now, a bit theory heavy. This is like slightly less related to QuantConnect, but it's pretty important to understand what type of orders you can do in a market, right? Okay, bear with me for a few minutes. Let's start with a market order. I've depicted a pretty simple diagram of what a bid-ask spread looks like. And essentially, the bid is defined as the highest price a buyer is willing to pay for something. Like you're on eBay and you're bidding for something, a bid. And the ask is the lowest price a seller wants to sell it at, right? And that makes sense, right? The buyer wants to offer higher and higher, the seller doesn't want to go lower and lower, and there's that kind of gap in between them, right? That gap is called the bid-ask spread, right? A little aside, the narrower the spread, the more liquid the equity, right? Because you have so many people just competing to get the thing that the prices come close to. Now, a market order is, a buy order is filled at the ask price, i.e. the one on the right, okay? And a sell order is filled at the bid price, which is the one on the left. Naturally, right? You can imagine, like, I typically like to think of it as the buyers stay on the left and the sellers stay on the right, okay? And it fills almost instantly, right? Because the reason it fills almost instantly is because the bid ask simply represents buy or sell orders that already exist. So placing the opposite order will essentially fill it completely, right? So it fills almost instantly. And of course, because it fills at the ask and bid price, you can't control that. So it's just whatever it is at that given moment, you will be paying the ask or the bid. And then a limit order. Now, limit orders are typically more common because it gives you some more flexibility on the price point at which you either buy or sell something, right? A limit order can specify the highest price you want to buy something for. So let's say, for example, I have put in a buy limit order for $100 for some quantity of QQQ, right? And someone is willing to sell at $99. Well, 99 is below 100, right? So anything less than 100 or less than or equal to 100 is great for me. So my order will execute, and vice versa for sell. And the only thing is, it may take longer to fill, and it might not fill, right? If you put like an outrageously low buy price at like $5, then obviously that's never gonna fill. So yeah. And then now the stock market, stock limit order, this is probably less common. I mean, no, actually you will be encountering that. So essentially it's basically a market or a limit order, except the order only gets put into the system. Notice I said put into the system, not executed. Put into the system when the asset reaches a certain price, right? You can think of them kind of as like scheduled orders in a sense, that when the price reaches some point, that's when it'll enter the system and then something will happen. This one's less important, on open or close order. These just execute when the market opens or when the market closes. And again, time and force. So this only applies to orders that, well, I mean, they apply to all orders, but I guess they're more relevant to the limit orders in this sense because, again, there's no guarantee that they'll fill. So let's say they don't fill, like how long should the order stay in the system until it should fill? There's three. You can either say good until I manually cancel it, or I have to wait until the end of the day, or I have to wait until some date in the future. And then we have cancelling and updating. This only happens for, actually this happens for every order except for a market order, because naturally a market order fills instantly, so you can't really change it or cancel it after that. Yeah. And then I show on the right some code. Again, all of this is available on the QuantConnect documentation. So. Oh, sorry. And yeah. And I also gave like a small code snippet as to how to update the settings. I will run through that one more time, but these snippets are mainly here just so that when you look through the slides again, it'll be like a nice quick reference as opposed to digging through the internet. Any questions on that previous slide? Okay. Oh, yeah, go.
What's QQQ?
QQQ. I think QQQ, if I'm not mistaken, is the ETF on SPY, which is the standard and pool.
NASDAQ.
Sorry, NASDAQ?
Yes.
Oh, sorry, NASDAQ. I'm not an equities trader, guys, I'm sorry. Okay, now position sizing and closing. Okay, notice here in this previous slide, I was specifying exactly how much I wanted. So I want 10 shares of QQQ, and I want to pay 420 for each one, right? Oh, by the way, a buy or sell is indicated by like a plus or a minus. So a plus is a buy and a minus is a sell. Here I'm manually specifying the quantity and like the price. In terms of quantity, if I don't want to sort of do that calculation manually, which is fair enough, you can actually allocate a certain percentage of your portfolio. So in this case, let's say I want to allocate 50% of my portfolio to QQQ. Then I can just say set holdings 0.5. Okay. And when it comes to order types, this is about entering position, right? The way markets work is you place an order to enter a position, and then you have to perform the opposite order to liquidate that position or exit that position. Anytime you're between an entered position and the exit position, you are susceptible to unrealized profit or loss because you haven't closed out your position. You're still, you can think of it as sort of being in the game, like you're in the ring. So stuff is still happening. Only until you exit the ring or you exit your position have you actually captured and realized all of your profit or loss. So in order to exit out that position, again, very crucial, don't let your profits go unrealized. Do self.liquidate on the ticker. Yeah. Okay, so that was kind of the basics. I just sort of, to recap, I walked through the initialize method, which is the basic setup. That's you always need. The on data, again, this is pretty general. I'll talk when I show the live algorithm and stuff. And the different order types and how to place them. That is crucial to making money, like entering and exiting positions. Okay, cool. So we're going to go through a live algo walkthrough now. This is something I will give credit to. There is a very good A through Z course on YouTube, and you know that's where I learned. This is pretty much just like a crash course to get you started because it is like a talk. Is it 20 hours? It's like something long. It's like a 15-hour course. So yeah. Now, before we start, in my opinion, of course, I'm sure Rudy might have some different opinions. An algorithm should follow these steps. The first thing is a hypothesis, like I mentioned, the hypothesis or the idea. Why do you think something is going to happen? And crucially, what's the rationale? In my opinion, from like what I've seen, algorithms with rationale tend to win more often because you actually have some explainable cause as to why it happens. And you know, whether or not it's true, your backtest or like will reveal that. But in terms of the idea itself, you should understand why the rationale, or like the rationale behind your idea. So that's the first one. The second step is then to do, I'll give you an example. So for the algorithm hypothesis, large cap stocks outperform small cap stocks over a long period of time, right? The rationale being that, you know, sort of more people invest into large cap stocks and typically they tend to do better because, you know, they have more resources and stuff. Now a development sketch. This is, I'd say this one's kind of optional. It's more just when it comes to actually structuring your code. So what methods are you going to use? What variables are you going to have? Are you going to have some help of methods? I sound like a computer science professor right now, but that's what I mean. Then initialize, make sure you get your universe, equity, and your extra variables all set up. And then the last one, which is the fun bit, is actually coding the algorithm, making sure it, like getting all the logic working. So yeah, I'm going to show you now the algorithm I've written. I'm going to go through this one a little slow. There. Okay. Yeah, I'll go through this a little slower because it is slightly complicated, and I think it'll make a lot more sense now that you actually see what the QuantConnect framework looks like. So you'll be on the home page and you'll see something called Create Algorithm, and then you'll be directed to this. So you'll only start with this import, this class. Remember how I meant, oh, it gives you a funny name. This class, and it inherits the QC algorithm. Remember the encapsulated state I was talking about? It'll do that. And you'll have two methods to start with. Initialize, the thing that runs once, and then on data. Actually, it's kind of analogous. Have any of you used Arduino before or ever coded in it? I mean, if you have, then you'll know that there's a the setup and then the loop one. That's the same thing. Like the initialize one runs once and the on data runs every time. Okay, now let's start by going through this. So to give you a quick overview of what this algorithm does, it essentially, I know I did just mention rationale, but the reason I chose this one is because it demonstrates a lot of different things that you will be doing in your algorithm. But it essentially buys QQQ and sets up a trailing stop loss. And what a trailing stop loss is, the stop loss simply moves with the price, right? Anytime, so for example, let's say for example you have your, sort of QQQs here at this point in time, right? You enter your position here, then immediately a trailing stop loss will be created, right? And it could go up, great, but your stop loss will sort of trail up with it. Like anytime it breaches a higher price point. So initially the first higher price point was here, second one was here, maybe third one's here. Each time it breaches a new higher price point, you'll move your stop loss up. Because obviously if you keep it in the same place, you're susceptible to losing more as opposed to less, right? So we simply move the stop loss up. And once we hit the stop loss, or once it's triggered, we'll exit our position and realize our profit or realize our loss. And then we'll have something called a 30-day cooldown period, or we're not allowed to invest for the next 30 days. Okay. And that's pretty much it. So I'm going to run through that algorithm now. Now, we're going to start at 2018 on the 1st of Jan, and we're going to go until 2021. And we're going to start with 100,000. Okay. Now, crucial, we're going to add our equity, QQQ, over there. As you can see, add equity, the symbol name, the resolution. So every hour, we're going to get hourly data, and we're going to return the dot symbol. Now, this is what I was talking about, the helper variables. So every order that you send, like a limit order, a market order, returns a ticket. And storing these tickets are useful, as you'll see in a bit. So we're gonna define these helper variables. So the entry ticket, the ticket of the order when we entered, so for example here, and then the ticket of the order where we trigger our stop loss. So for example here, right? So entry and then exit. So each of those orders will be stored. Yeah, and then benchmarking. So, did I talk about the Sharpe ratio? Oh, sorry, I completely forgot about to talk about the Sharpe ratio. Okay, so when it comes to algorithm development, there's mainly two things to sort of measure your backtest. well, I mean, there's more, but for now, the two that I would worry about are Sharpe ratio, max drawdown, and then also a benchmark, right? So Sharpe ratio, I mean, there's a formula, but intuitively what it means is, in a fair world, the reward you get is proportional to the risk you take. Something that demands more risk should necessarily mean you get more reward for it, naturally. Now, in a market, for your algorithm to do well, you want to get as much reward as you can for as little risk as possible. And that's exactly what the Sharpe ratio defines. It is a term defined to use the risk-free rate. So how much return you get, and then you discount the risk. And that should, at the very minimum, be a 1. Like, that should at least be 1, because that indicates, like, okay, I got exactly what I risked. Like, the reward I got is exactly what I risked. But ideally, like some of the best algorithms, like around 3. And then a benchmark is simply just, you're going to compare your algorithm to the equities that you're trading. Because if your algorithm performs worse than your benchmark, you could have simply just like invested in the benchmark itself and you would have done better, right? Okay, now back to the algorithm. I am digressing. So that's why we set our benchmark as QQQ. And then our helper variables, we're going to talk about the time we entered and the time we exited. And the reason for that is because we're going to use that for a cooldown period, right? We're going to note down like our exit time, and then at each step of time, so every hour we're going to check, oh, has it been 30 days? Has it been 30 days? Has it been 30 days? Right. Okay, and in order to define the stop loss, remember how I said that every time we breach a higher price point, we're going to move up the stop loss? That's what this is going to do. We're going to store the highest price at each point. And notice how all of these are defined in initialize. That's because we don't want these values getting lost every time on data gets called. Because if you think about it, on data is on the stack, and then once the call is finished, it'll destroy. So anything stored in on data, like any variables that you want consistently throughout your algorithm that needs to stay global should be in initialize, and then all of your little smaller helper variables should be on data. Does that make sense? Yeah. So we'll talk about on data now. Remember this guy, self.time? Yeah, we're going to use self.time. And all this defines is our cooldown period. So we're going to check the last time we executed our stop loss. That's what that means, stop market order fill time. So when we executed our stop loss, at what time did that happen? And we're going to compare that to our current time. Now, if that is less than 30 days, just end on data, we're not going to do anything, because we're still in our heat period. Then yeah, so first thing to get is obviously the price of the equity you're dealing with, so that's how you obtain that. Securities of self.qqq.price. And yeah, so we're going to, is that? Yeah, so we're first going to try and invest, or try and enter a position. Now, you can only enter a position if you haven't invested your portfolio. So what I mean by that is, in this algorithm, we're just going to invest our entire portfolio into QQQ. Don't do that in real life. Do not invest your entire algorithm in one thing. You will lose money. So that's what we check. So if not self.portfolio.invested, so i.e. we haven't entered a position, and this is also just another check. We look at any of the open orders. So have we submitted any of the limit, like have any of our limit orders not filled? Like the reason for that second one is because you could have sent a limit order but it not be filled, and then if you send another limit order, like if you've already invested your entire portfolio, how can you send another one? So you're just making sure that your order hasn't been filled and there aren't any live orders waiting to be filled. Hopefully that makes sense. And in that case, what we're going to do is we are going to calculate.
Sorry, can you make it a little bit larger?
Oh yeah, for sure.
I'm trying to mark.
Yeah, no, sorry about that. Just move this all around a little bit. Is that better?
Yes,
You guys
yes.
read that? Okay. Great. So what we're going to do, so this calculate order quantity essentially means, oh sorry, okay. We're not investing all of our portfolio, only 90% of it. But essentially what it means is this function simply calculates at the current price of QQQ, how much quantity do I need to buy so that 90% of my portfolio is invested, right? So that is simply just a calculation that gives you the quantity. And then, like I said here, the limit order. We're going to submit a limit order on our symbol, QQQ, at the calculated quantity, at the given price. The tag is simply for debugging, that's useful. And remember how I said it returns a ticket? We're just going to store that ticket. You know, no harm in storing that. And crucially, we're going to define our entry time. So when did we enter a position? Okay? So that's entering the position. Now, crucially, because we're submitting a limit order, it may not fill. Remember how I said a limit order may not fill? If that's the case, we want to update our limit order so that it becomes a nicer price to fill. So what we do is we check, okay, the entry time. So when we submitted the order, if it's been more than a day and the order still hasn't filled, then, and like I said, the status hasn't filled, then we're like, okay, maybe our price is too high. Maybe we should bring it down because we're trying to buy it. Sorry, we're trying to. Let me see. Yeah, we're going to update our limit price so that it's easier for us to actually fill our order. So we're going to try again, reset the price, because obviously this time we're submitting like we're updating our order, so we have to update our entry time. And this is simply you can imagine this update order field. It's just like an object of a class, and the reason for using it is because you just sort of place all of like the parameters you want to update in this structured object, like update order fields, and then you simply chuck that into the update ticket entry. You're less likely to make mistakes with this because there are predefined fields in here for you to update. And then, so you basically provide the current QQQ price, update your limit price to that, basically as like the middle of the bid-ask spread. So typically like the fair price of something is defined as like the middle of the bid-ask spread, because naturally like the buyers want to give you the maximum of this, the sellers want to give you a minimum of that. Take it down the middle, that's approximately what people think the fair price is. So we're going to re-offer our price at the new price. And yeah, we're just going to update our order simply by doing update and then passing in our object. So yeah, hopefully by doing that we will have entered a position. Now, before going into this one, it's important to note this method down here, on order event. So what on order event is, it is called every time some kind of order event occurs, whether that be creating an order, updating an order, deleting an order, filling of an order, anything like that. Right? So just in terms of my code explanation, I'm going to sort of branch down to here, because let's say, for example, we placed in an order and it's filled, or it's been updated. Our control flow, or the flow of the platform, is going to go to this one, on order event. Now, if it's not filled, we're just not going to do anything, naturally. But in this case, remember how I said as soon as we enter, we need to define a stop loss? That's what we're going to do here. So if this just checks sort of the entry ticket, remember we store the ticket of our limit order. So if that's actually happened and the ID of the order event, so the thing that happened, so the update of the order, the cancel of the order, whatever, if that matches the sort of what we're looking for, then we need to actually create our stop loss. Now we're going to set our stop loss at 5% below what our limit order is at. So essentially what we do is we place a stop market order. Remember how I mentioned before that this order only goes live as soon as a certain price point is reached? Well, that's exactly what a trading stop loss is, right? As soon as the price hits our zone, then the order goes live. And because it's a market order here, it'll execute immediately. And that's what we want. We don't want to wait as soon as we hit our stop loss. We want to exit as quickly as we can. And as you can see here, it's going to be exactly the negative of our entry, because if you buy 10, you need to sell 10 to exit. And we're going to set it at 5% below what the average fill price is. Do you guys know what the average fill price is? I'm just curious. No? Okay. So the average fill price is simply, because a market works with like a bunch of different buy orders and a bunch of different sell orders, there's no guarantee that your order is going to fill at the exact price you defined. Then maybe it may be filled at a lower price, it may be filled at a higher price. So just because of like a lack of quantity at your price point, so let's say I'm buying 10, and I'm buying 10 shares at $50, say. Then someone is selling 5 shares at 50, but then the next person is selling like 5 shares at 51, or your average fill price is 50.5. Yeah, okay. So that defines our stop loss. And then again, we just sort of, yeah, so that's our stop loss. Okay, I'm gonna leave this bit, I'm gonna come back to it because that is the next step of our algorithm. Cool, so just to recap what we've done. We've set up our universe, we have created the limit order to enter our position, and as soon as the position got entered, we go down here to this on order event. This gets called whenever an order thing happens. And then you just make sure, hey, are the conditions viable for me to create my stop loss, i.e. did my entry order get filled and does it actually exist? Right. Now, this is the trailing part of it. Essentially what we do here is we check, do we have a stop market ticket, i.e. do we have a stop loss in place? Okay. And are we invested? So do we actually, have we entered a position? In that case, we simply want to check if we breached our next price point, right? Because that's our behavior for moving the stop loss, right? So in the scenario that the current price is greater than our last highest price, then we need to move up the stop loss. So we set the highest price to the current price, and then we update the stop loss price with 5% below the highest one, i.e. the current price. And then we just send it to our stop market ticket. Remember, that's our ticket for the stop loss. We're just going to update that to be 5% below the current one, like the new higher price that we're seeing. And this will be useful for you guys in your debug. So in this case, you're just going to print this to console, and adding these tags just helps you see the behavior of your algorithm. Okay, so a couple scenarios that I just went through. So entering the position, that was one. Making sure that, hey, how can I actually enter it? So updating the price to make sure that the limit order actually fills. Then let's say it does fill, then we're going to create our stop loss. That's what we did in the on order event. And then we just talked about where if it breaches a new higher price point, moving the stop loss. Okay, that's what we've done so far, just to recap. Now let's say the last part of our algorithm is exiting, right? We just talked about entry and maintaining our stop loss. Now let's talk about exiting. Now that's what's going to happen down here. So when will we exit, right? Our exit is defined when our stop market order fills. And that makes sense, right? Like our stop market order only executes when the price hits it. So what we're going to do is when the price hits that stop market order, an order event is going to happen. So this method is going to get called. And we're going to check, hey, is the filled order the one we're looking at? Okay, great. So now we need to exit our position. So we're going to update the time, like the end time of our position with the current time. And we're going to reset the highest price, right? Because we don't know QQQ's next highest price entry, right? Like highest price is only defined when you enter the position, right? So that's why we just reset it to 0. Yeah, I think just if that was a little hard to follow, I completely understand. Switching into this framework, into this frame one is difficult. But essentially, the way to think about this is, when should I enter my position? Like, what are the conditions for entering? In this case, I just entered, like, because of when I'm not in the cooldown period. Then within your frame, right, what needs to be updated? In this case, I'll stop loss. In your algorithm, it might be something else. And then when should I exit? These three things, if you can just think about your algorithm from those three perspectives, that's already like half the battle. You just need to write the code and write the conditions. Now the fun part, let's backtest it. I don't know what it is with these names. Emotional brown pig, orange camels. Wait. So what QuantConnect will do now is it will host like a little runner and it will run your algorithm. You can also upgrade to higher, like you have to pay them and you'll get access to things like more of these. You'll be able to live deploy them. You'll be able to connect to like a brokerage account, stuff like that. Yeah, okay. So yeah, our algorithm, well, over the past 3 years we made what, 30 grand, 31 grand? Great. In reality, if I was to execute this now, I'd probably lose the portfolio because this algorithm makes no sense. Like it enters and it has a stop loss, but this is a good scenario that it only goes up. What happens is it just keeps going down every time. Like on average, you might lose more than you win, so it's pretty much like a 50-50, do well or do not. Okay, key things to analyze. This will just tell you your equity for each period. So for example, this is April, the month of April, your OHLC, and then your return that you got during that period. This is candlestick data, by the way. Are you guys familiar with candlestick data? If you're not, I can briefly explain that. So, okay, so a candle essentially works like this. Remember how I was talking about a bar? That's exactly what a candle is. Low. Oh, sorry. Okay, so within each bar, this is just like a convenient representation of it. So the lowest price point is like the end of the wick at the bottom here. The highest is the top of the wick. And these just represent either open or close. So if the open is higher than the close, the candle's red, right? But if the open is lower than the close, the candle's green. Because it started low, went high, red. If it started high, went low, bad, right? Yeah. So you can use that to sort of analyze and see exactly how your algorithm is performing. But the most important thing that I would say is the shot. Yeah.
Question, sorry. If you look at the candlestick data,
Yeah.
you said this is open and closed, and then is the next candlestick, is there a time in between? Because otherwise,
Yeah.
they must be at the same part, right?
Yeah, so for example, if you can see here, it says December 10th, 2020. Here it says December 11th. So these are like daily candlesticks. You can adjust these as needed.
Oh, I see.
Why does
Your question is that there's slippage in the market, so that's the bid-ask spread I was talking about. So that's why some candles look at it a little this line. But he also
like
zoomed in a lot. So you hit the all button on the strategy equity, and you like see like the big graph, like they should align.
Okay,
Right? It's just like a little bit of
It was just a
slippage.
lot of difference. Okay, thank you.
Yeah, no, it's
Especially like in when the market's falling, there usually is a lot of slippage. So you see like candles that don't align very well.
Yeah, so the important thing is Sharpe ratio. Obviously, as you can see, this is less than 1, not great because we risked more than what we got. And I mean, it shows we performed well, but remember how I said take a back test with like a grain of salt? This makes no sense, or like very little sense. Like there's no reason this should actually work, and yet we have profit. So a back test is like really not indicative, it's just like a sanity check. And this is not a good enough sanity check because the Sharpe is just terrible. At least it's not negative, but that can happen, just be careful. And yeah, so there's also something called maximum drawdown, and what that means is, oh yeah,
Can you
Yeah,
explain
yeah.
what's a Sharpe ratio and why
Yeah.
it's not good if it's below 1?
yeah. So a Sharpe ratio essentially, in an intuitive sense, means that, like I said, risk and reward should be proportional, right? Like you should get what you put up risk for. So if you put up more risk for something, you should expect more reward in return for putting up with that risk. Now, a Sharpe ratio of 1 basically means you've won fairly, or it's fair, right? Like I've put up X amount of risk and I've got X amount of reward back. Right? But if it's more than 1, then that says, well, actually I got more reward for less risk, which is always great. And if it's less than 1, it's like, well, I risked more and I got less. That's not great. Does that make sense?
Yes.
Okay. And
If you're taking backtesting with like a grain of salt, then how do you know when you have something that actually works from this field?
great question. Yeah. So Sharpe ratio and max drawdown. So in this case, my Sharpe ratio is less than 1. That's not great. So if your Sharpe ratio, I think Rudy can probably clarify this, but I think we're judging your algorithms based on Sharpe ratio. Are we doing max
Yes,
drawdown?
yeah.
Yeah. So we're judging your algorithms based on the Sharpe ratio. Typically, like a very solid algorithm is like around a Sharpe ratio of 3. I mean, I've seen algorithms. Is it 2?
Good haircut.
I've had, no, high standards always 3. Sure, okay, so it's between like 2 and above. But I've seen like some algorithms where they're like 4 or 5 in academic papers. That's all like theory. It's kind I don't trust that. There's probably a lot of assumptions going on. But essentially, yeah, if your Sharpe is above 2, you can be fairly certain that, hey, okay, this, if you have a good rationale, you have a Sharpe above 2, that's probably a good indication that you've done something right. I would definitely like obviously for the competition it's a little bit long, but if you're doing this on your own, I would live trade it on paper trading so that you're not actually risking any money, because live paper trading gives you an insight that backtesting won't, right? And I can actually speak more about that when it comes to machine learning in a second if you want to talk to me also, or if any of you are interested. But yeah, so to judge, Sharpe ratio above 2 is the goal. Yeah. Any other questions? Just based on that. Cool. So, yeah, so there's the Sharpe which I just explained. Maximum drawdown is in terms of your P&L. Let's say you've made some money, and then you start losing a lot of money, like afterwards. The max drawdown simply represents, or how much, like what's the maximum peak to trough that you've lost over the entire course. And the reason why that's important is because you need to recover that entire max drawdown. So the larger the max drawdown, let's say you decide to scrap the algorithm, well, your max drawdown will basically tell you in the worst case you've lost this much money before scrapping the algorithm. So the lower the max drawdown, the better. And I will say, just like a few asides, this I learned a lot of this from Dr. Ernest Chan's book. He writes really well. It's that book got me hooked actually. It's called Quantitative Trading. I can share that with you. But essentially, risk management is the first thing, right? Defense necessarily leads to attack, and an analogy can be sort of like in a boxing ring. Let's say you have the best, every punch of yours is a knockout punch, but if you don't survive long enough to even throw that punch, what's the point of having that punch, right? You need to be able to defend yourself in order to attack, and that's kind of the same analogy when it comes to trading, right? You need to, if you haven't got your risk managed, you could potentially win big, but because your risk isn't managed, you just keep losing until all that win is just gone, right? So in your algorithm, risk management is crucial. And that's why I would always say having some kind of stop loss or some criteria that basically says, hey, we should exit to prevent further loss, that's always important. And well-reasoned strategies can win. Now, you might be wondering, well, this is my first time, how am I supposed to come up with a new idea or something? Which is fair enough, I was also in that position, and I'll talk about it in a second. So, tips and tricks. Original ideas are great, of course, if you have that prior background knowledge, that's always great. But obviously not that easy. And there's actually there's a huge directory of published research, published strategies, whether that be from sort of members of the community, professional traders, academic professors, everyone like that. They actually publish their strategies. And, well, why would you publish a strategy, right? Like, aren't you just revealing secrets? But that's not necessarily true. And the reason for that is a lot of these strategies do exist. Like, I've told you about this strategy. But if I told you, well, when do I enter? Like, under what parameters do I enter? Should it be a 5% stop loss? Should it be a 10% stop loss? How long should my cooldown be? Should it be 30 days? Should it be 10 days? Should it be no cooldown at all? These different parameters are actually what makes a strategy a winning strategy. And that's something you guys will experience optimizing and testing these various different strategies, right? So publishing research is a great foundation to get started. And as you can see, there's a bunch of resources. So QuantConnect actually has this strategy explorer page. Yeah, so for example, some example strategies, like for example, US equity, ETF basket pairs trading, you can have a look at that, see how it's performing. There's like live results, backtest results, and the code itself. So, yeah. So you can analyze all of that. There's also Quantpedia, that is kind of like a directory of pre-compiled research papers. There is a paid version, but the free version gives you plenty of access, at least from a beginner perspective. You can even look up on like ARX IV, so that has like a quant section to it, as well as any sort of business school. And yeah, there's honestly, even if you just start looking up, or even ask ChatGPT, like it'll give you some good places to start. And I will end with some general tips. So you should start simple and then scale, right? Having like a neural network algorithm right now as a beginner, it's ambitious, and obviously neural networks are fun, but if it goes wrong, you're not going to know how to fix it. So stick with one asset or one or two assets, one signal, and clear and simple logic. You should be able to explain what, like, the rationale behind it, if you can. Of course, if you can't, then that's okay. Manage your risk. Put in your stop losses. Define very hard defined exit conditions. Make sure your algorithm sticks to that, and ensure that there is some kind of rationale. And test. Make sure you backtest through multiple periods. Obviously, really is going to be randomly selecting a backtest, so it's a good idea to just go through some of them and see how it performs. Yeah, and that's basically it. There's some credits there. So, for example, the algorithmic trading A through Z, trade options with me channel on YouTube. Actually, really recommend this. By hands down the best tutorial I've used for QuantConnect. I would highly recommend if you want to go into more detail. It covers a lot of things like windowing functions and stuff like that, which are used for more complex algorithms. If you're interested in books, Quantitative Trading by Dr. Ernest Chan, he actually mentions how he started his own algorithmic trading business. And of course, he mentions you don't even need to be a huge math whiz. You can do it just as someone with basic high school math knowledge. Strategy Explorer and Researcher are always two good places. So yeah, thank you very much for listening. I know it was pretty technical. Yeah. Any questions? Anything? Feel free to come up and chat to me if you want ideas, or I can yap about my own idea. Yeah, and reach out to me on Discord. My name's there. You can reach out to me on Instagram, LinkedIn.